Hello and welcome to KBRA Clips. I'm Kate Kennedy and I head our media relations efforts, and I'm joined today by Brian Ford, Senior Director and Head of Structured Finance Research. Welcome, Brian.
Thanks for having me, Kate.
Sure. So it looks like you just published our Structured Finance Outlook for 2018. So tell me a little bit about it. What are your broad thoughts on structured finance for 2018?
Sure. So I think the major themes of 2017 were really strong investor demand, as well as benign credit fundamentals across the majority of credit structured asset classes. And I think that contributed to tightening spreads as well as strong returns across ABS, CMBS, and RMBS. For 2018, we're expecting more of the same. I think technicals should remain supportive. Investor demand shows no signs of letting up at this point. I think credit fundamentals are in a really good place, both from a real estate and from a consumer credit perspective. And I think, as the Fed continues to raise rates, pushing all-in yields higher, there is room to tighten across the structured credit markets. That said, we are at multi-year tights at this point. So I think there is more room lower down the credit curve, but at the AAA level, we'll likely have stable spreads throughout 2018. In terms of supply forecasts, we are forecasting a slight contraction of the structured credit volumes for next year. A lot of that is driven by lower CMBS issuance, just due to a lack of maturities in 2018 on the conduit side. On the ABS side, we're forecasting a 3 to 5% decline, mostly driven by auto-related issuance. What you've seen is U.S. vehicle sales have started to plateau and even decline slightly, as well as a weaker used car market we think will contribute to a lower amount of issuance in the auto space next year. Finally, I think some of that can be made up in the RMBS space. We have seen a widening of the credit box for a number of issuers that we rate. So I think as there's origination lower down the credit curve, there is an opportunity for increased private label RMBS issuance next year.
So what would you say are the biggest risks then for 2018 across the market?
Yeah, so risks certainly exist. I think any kind of risk-off environment will likely be more macro-driven than come from within the structured finance markets. At the top of our list is geopolitical in nature, given the continued saber rattling on the Korean Peninsula. But there's certainly a lot of policy uncertainty given an incoming Fed chair as well as 3 vacant positions on the Board of Governors, all of which can cause some policy uncertainty and a rise in volatility in 2018. Other prospective risk-off catalysts could certainly be a surprise in terms of the looming debt ceiling deadline, as well as some kind of miss on tax reform that's currently working its way through the House and Senate. That said, though, I think with the expectation for an expanding economy next year, as well as having the consumer being in a very good place on from a financial footing, we would expect more of the same in 2018.
So speaking of consumer, what would you say are the biggest credit concerns for the consumer?
Yeah, so I think that was definitely a major theme within structured finance this year, especially within the ABS markets. You have seen delinquencies and loss rates on the rise across a number of asset classes, whether it be subprime autos, unsecured consumer loans, and a number of different other asset classes. There has been some concern that the overall rise in debt, which has now surpassed 2007 levels, could be the next bubble. Now, I think from our perspective, it's a lot less ominous than the headline numbers would indicate. If you look at consumer leverage or household leverage, which is the amount of debt to the amount of income that a consumer has, we're seeing that well below 1 times, which is comparable to 2002 levels. Possibly more importantly, from a cash flow perspective, we're seeing debt service coverage ratios, or the amount of disposable income to debt service payments that households are having to make, at above 10 times, which has never been seen since the Fed has been keeping this kind of data. So from that perspective, we think the consumer is on a very good financial footing. Pockets of concern do exist, though. We have seen stagnant wage growth for lower and medium income households, which are probably have an outsized exposure to the more subprime, non-prime borrower. So as credit has become more available and wages have been stagnant for that income part of the income distribution, there is some concern there. I think it's at this point just something to watch and not overly concerning from a credit perspective, given what credit enhancement levels are across structured finance.
Okay. So with all of this being said, what do you think this all means for the structured finance investor?
Yeah, so I think from an investor perspective, credit fundamentals remain very benign. Credit enhancement levels very robust. So there shouldn't be that much concern from a credit perspective in 2018. But as we talked about earlier, there's absolutely a possibility of a risk-off environment, but that will be more macro-driven, whether it's a policy miss, legislative miss, or some kind of geopolitical risk. But outside of a macro sell-off, we would expect spreads to continue to grind tighter and for 2018 to be another solid year for structured finance.
Great. All right. Well, thank you, Brian, for joining us.
Well, thanks for having me, Kate.
And thank you for joining. Brian's Structured Finance Outlook piece can be found on our website, kbra.com. Everything is free of charge, so just register and you can view. Thank you.